Joining me is David Zervos, the chief market strategist at Jefferies. David, it's great to have you here today. Are you still sort of on the dovish side of things?
You know, I'm certainly more hawkish, Kelly, than I've been in the past, but that probably, relative to the median of pundits out there, I'm probably still more in the dovish camp, just because I have, long-term disinflationary views that I believe will come back into the system probably more for the second half of the year once the supply disruption storyline begins to dissipate. But we still have to get through a rough Q1 and possibly Q2. But I think we're going to start to see some real inflation headline drops as the Q2 comps are really going to be hard to beat. But that's not the first quarter's trade.
Right, exactly. You're talking about, first quarter, second quarter, even tomorrow we could still see some pretty high reads. So, and I know you've still been pretty constructive on stocks overall, but trying to figure out what the Fed's reaction function is going to look like this year. Walk us through some of these scenarios as we're starting to hear people talk about 4 rate hikes from Goldman, more than 4, Jamie Dimon's personal opinion. What do the tea leaves say to you?
Well, first, I'll just say, Kelly, I've probably come in the least optimistic that I've been in 12 years at Jefferies in terms of upside. I think the real risk is that, and I still have upside, maybe call it 50% of what my usual is in terms of allocated to risk assets. But the reason is really that I think the Fed put, or the downside is really not very well protected by the Fed. So I feel a lot less comfortable with them coming in and doing their usual backstops in a 10 to 15% down trade. I think it's more like a 20 or 25% down trade where they might come in. So I'll leave that out for you to start with. But, in terms of 4 rate hikes, 3 rate hikes, 2 rate hikes, I think it's a really tricky one because my bet and my inclination is to believe that the balance sheet is going to play a more prominent role in this tightening exercise. And the more they go for a more rapid cessation of the reinvestment of proceeds from the mortgage and treasury paydowns, or, and this is the wild card, Kelly, or choose to sell assets, which they did not do last time, but was certainly a topic of discussion back in 2010 when they were first discussing balance sheet normalization. I think there could be an interplay there that means the short end is not as much of the lever as the markets might be thinking here, and that could work against some of these flattening bias trades that are out there.
Why don't you think they're going to be as quick to react? The market has actually been telling them they're wrong when they were tightening last cycle. They would try to tighten, they would talk about 4 rate hikes, and the market would push back, and they would basically concede the point. Why do you think it's different this time?
Well, I think, the market has been very optimistic about the long-run inflation pressures. The break-even inflations, in the long run, 5-year forward inflation break-evens were unchanged last year, Kelly. People do not expect this to be a significant permanent inflationary event, at least those betting in the market. There's plenty of pundits that do. So I think they're often much more worried about the Fed overdoing it in its reaction to this very high set of inflation numbers that we have today, as opposed to losing credibility and underdoing it. And in fact, you've got 30 years of history that says that disinflation has kind of dominated inflation when it comes to the risks. I do think as well, Powell has a legacy to think about. He doesn't want to go down as the guy who, undid 30 years of Paul Volcker and Alan Greenspan and Ben Bernanke and Janet Yellen's hard work. So he has an incentive to be a little bit more hawkish here. And that's one of the reasons I'm coming into this year a lot less constructive than I usually am. I'm usually one of your most optimistic guests.
Yeah.